Has the crypto market just hit a brick wall?
The same brick wall.
Over the past 3 days, we've seen a brutal sell-off that's wiped out weeks of gains, sending a wave of fear through the market. Some are calling it the inevitable result of a sell the news event after the Federal Reserve's latest meeting. Others believe the curse of Rektember is alive and well, and that this could be the end of the road for altcoin season. But what if I told you that buried deep within the sea of red are the signals of a potential market setup? A scenario that could line us up for the most explosive quarter of the year. My name is Guy, and you're watching The Coin Bureau. First up though, I'm not a financial advisor and nothing in this video should be considered financial advice. This is purely educational content meant to inform you about the latest crypto market developments and their potential impact. So if that sounds good, hit those like and subscribe buttons and let's get into it. So, to understand where we might be going, you first need to understand exactly what just happened. The past 72 hours have been a bloodbath. Bitcoin plunged more than 3%, slicing through key support levels to trade below $113,000. Ethereum got hit even harder, falling 7% to test $4,150. And major altcoins like Solana, XRP, and Cardano saw brutal drops of 6 to 10%. But the real story isn't just the price action. It's the catastrophic liquidation cascade that fueled it. In a single 24-hour period, over $1.7 billion in leveraged positions were forcibly closed. And a staggering $1.6 billion of that sum was long positions, meaning traders betting on higher prices were completely wiped out. This was the single largest liquidation event of 2025, impacting over 400,000 individual traders. So, what triggered this perfect storm? Well, it was a confluence of factors. First, we had a triple-witching crypto options expiry, where over $17.5 billion in Bitcoin options and $5.5 billion in ETH options matured, creating immense volatility. Second, from a technical perspective, Bitcoin had repeatedly failed to break the critical 118,000 resistance level, signaling exhaustion to traders. But the primary psychological driver, the event that lit the fuse, was the Federal Reserve's FOMC meeting. And this is where things get really interesting. On the 17th of September, the Fed did exactly what the market expected. They cut interest rates by 25 basis points. Now, normally, lower rates are rocket fuel for risk assets like crypto. So, why the dump? Well, the answer lies in a classic market adage: buy the rumor, sell the news. The rate cut was already priced in. What wasn't priced in, though, was Fed Chair Jerome Powell's hawkish tone during his press conference. Powell was careful to frame this decision not as the start of a major easing cycle, but as what he called a, quote, risk management cut. He emphasized a meeting-by-meeting approach and reiterated that the Fed's stance remained, quote, moderately restrictive. Now, the market heard this and immediately began to price in a less dovish Fed than it had hoped for. Long-term Treasury yields, which had initially dipped, rebounded sharply. The result was a textbook sell-the-news reaction. Over-leveraged traders, meanwhile, who had piled into long positions expecting a dovish pivot, were caught off guard, and the liquidation cascade began. And this brings us to the bigger narrative battle that's now playing out, the Rektember curse versus the Uptober promise. Historically, September has been a brutal month for crypto. Since 2013, BTC has posted negative returns in 8 of the last 12 Septembers, with an average monthly loss of 3.77%. This recent crash has certainly made it feel like the Rektember curse is in full effect. Bitcoin dominance rose sharply during the dip, climbing to over 57% as capital fled from battered altcoins back into the relative safety of BTC. This has taken the altcoin season index back to just 41, well below the official alt-season mark of 75. So, the question on everyone's mind is this the start of a deeper correction? Or is this September weakness simply the springboard for a massive Q4 rally, as has so often happened in the past? And if you want to take advantage of the volatility that's coming, then you need an exchange to do so. And how does $20,000 in sign-up bonuses sound? Or how about a new iPhone giveaway? Well, we have an amazing competition right now with BitGet, a top-tier global exchange with all the features and coin support you need. If you sign up and create an account right now using this QR code over here, or hitting the link in the description, not only will you be able to take advantage of that 20K bonus, but you'll also be entered into a competition to win a brand new iPhone. The winner will be announced on one of our Monday live streams. So sign up right now while this competition is still on, because it won't be around for long. Okay, so with the stage set, let's get to the most important question. What does all of this mean for the next 3 months? Well, despite the recent carnage, the bull case for a strong Q4 remains compelling, and it's built on 3 powerful pillars. The first pillar is the institutional tsunami. This cycle is fundamentally different because of the sheer volume of institutional capital entering the space. The spot Bitcoin ETFs have been a monumental success, with global assets under management hitting $179.5 billion by mid-2025. But here's the real kicker. The altcoin ETF pipeline is now primed for Q4. Bloomberg analysts are giving spot ETFs for assets like Solana, XRP, and Litecoin a 75 to 90% chance of approval before the end of the year. And this isn't a minor development. This is a potential floodgate opening for billions of dollars in institutional capital to flow directly into top-tier altcoins for the first time. Meanwhile, alongside ETFs, we have the rise of digital asset treasury companies, or DATCOs. Firms like Strategy, which now holds over $70 billion in Bitcoin, have created a playbook that dozens of other public companies are now following, creating a persistent structural bid for crypto assets. Next, the second pillar is the Fed's liquidity pipeline. Yes, Powell's tone was hawkish, but let's not forget the Fed's own forecast, the dot plot. It still shows a median projection of 2 more 25 basis point cuts before the end of 2025. Now, historically, a Fed easing cycle is one of the most powerful tailwinds for risk assets. As the return on holding cash goes down, capital seeks out scarce, non-yielding assets. And there is no scarcer digital asset than Bitcoin. The third pillar is historical momentum. As brutal as Rektember can be, it's often followed by Uptober. October has historically been one of Bitcoin's strongest months, with an average return of nearly 23%. In every single one of the past 3 bull cycles, a September slump has set the stage for an explosive Q4 rally. So, if history is any guide, this current weakness could be the final shakeout before the next major leg up. But of course, no bull case is complete without acknowledging the risks, and there are serious ones to watch out for. The primary risk is the simple fact that the market remains over-leveraged. The recent cascade was a stark reminder of how quickly things can unravel when sentiment shifts. Another major concern is the broader macroeconomic picture. Lingering recession fears and weak global economic data could create a risk-off environment that drags crypto down along with traditional markets like the Nasdaq. And finally, we have critical technical levels to watch. For Bitcoin, the zone between $104,000 and $107,000 is the line in the sand. This area represents a major psychological and technical support level. A sustained break below this zone would seriously damage the bullish structure that could signal a much deeper correction is underway. So, to recap, the brutal sell-off of the past few days was a perfect storm of over-leveraged positioning, a classic sell-the-news reaction to the FOMC and the historical weakness of Rektember. It was a painful but necessary reset for a market that had gotten ahead of itself. However, the fundamental drivers for an explosive fourth quarter remain firmly intact. The path of least resistance still appears to be higher for crypto, but it will not be a straight line. The convergence of an institutional tsunami via ETFs and corporate treasuries, an incoming liquidity pipeline from the Federal Reserve, and powerful historical seasonality creates a setup unlike any we've seen before. And this isn't just about retail FOMO anymore. This is a structural shift in how the world's largest pools of capital view this asset class. The key is recognizing that this recent correction, while painful, may have been the final shakeout needed to build a sustainable base for a massive Q4 rally. The odds, folks, are now leaning in favor of the bulls. And if you want to see our deep dive into which altcoins could lead that rally, then check out our video on that right over here. And if you haven't subscribed to the channel yet, you can do that right over here. As always, thank you all for watching, and I'll see you again soon. This is Guy, over and out.